How to move your 401k into an IUL life insurance policy by www.annuityquoteadvisor.com. If you are no longer working for an employer, you have the option to roll over or move your 401k into another retirement planning vehicle. Some investors may choose to use an IRA, but others may opt to put a portion of their savings into a life insurance policy with cash value. You can do this before age 59 and a half and avoid the additional 10% tax penalty by utilizing an exception to Rule 72T of the IRS tax code involving IRA funds. Under Rule 72T of the IRS code, you pay an additional 10% tax for any distributions from your retirement plan before age 59 and a half. This is over and above the ordinary income tax that applies to the withdrawal. Your employer contributed a portion of your paycheck and possibly matching funds into the 401k. You incurred no taxes, and the funds grew tax-free while in the 401k. At age 59 and a half, you can start withdrawing the money. However, you'll have to pay ordinary income tax on the withdrawals, unless it's a Roth 401k. To avoid the additional 10% tax, you have to withdraw the funds in substantially equal periodic payments. To qualify for this exception, you must make these periodic payments over your life expectancy or the life expectancy of your designated beneficiary. The IRS allows 3 methods for calculating these payments that make use of a mortality table. Once you set these payments up, you cannot adjust them within 5 years of your initial payment except for a death or disability. If you do make changes, you'll lose the exception and have to pay the 10% tax. Because you can only use this exception with IRAs, you will need to roll over your 401k into an IRA, then take distributions from the IRA. To do this, simply request a direct rollover form from your 401k administrator and open an IRA with your broker or bank. If you do a direct rollover to an IRA, you will not incur any tax consequences. Next, you should set up your permanent life insurance policy, or IUL. You need to use a permanent policy, such as whole or variable life, because it has a cash value and offers you retirement planning options and tax benefits. After you apply for the policy, contact your brokerage or financial advisor to get the paperwork for withdrawing funds under the Rule 72T provisions. To figure out your periodic payments, it's a good idea to work with a financial or tax advisor who is experienced with calculating these types of payments. If you do this properly, the IRS taxes the payments as ordinary income, but will not assess the additional early distribution tax. And that's where we come in. At Jennifer Lang Financial Services, we specialize in annuities, indexed universal life policies, 401k, 403b, and IRA rollovers. We work with over 25 of the most top-rated carriers to find you the best rate. Put our expertise to work to design you a tax-deferred or tax-free strategy that will protect your financial goals and timeline. Visit us online today at www.annuityquoteadvisor.com. Thank you for attending. Stay safe.